Your first mortgage payment may feel like progress, but most of that money may not be building ownership at all. Before celebrating the payment, audit where every dollar actually went. Today, you will learn how mortgage payments are split, why interest dominates the early years, how amortization really works, and how to evaluate housing costs with financial discipline. The key lesson is simple. A payment can feel responsible while doing very little to grow your net worth. Buying a home feels like a major life milestone. After years of saving, paperwork, stress, and waiting, the first mortgage payment often feels like proof that you finally own something meaningful. Many people tell themselves they are no longer throwing money away on rent. They assume every dollar in the mortgage payment is helping them build wealth. That emotional satisfaction creates a powerful sense of progress before the numbers are ever examined. The trap begins when people confuse making a payment with making progress. Rent is easy to understand because it clearly buys temporary shelter. Mortgages feel different because they are associated with ownership. But early mortgage payments do not create equity in a straight line. Someone can comfortably afford the payment while completely misunderstanding how slowly the loan balance declines. The payment feels productive, so most people stop inspecting what it actually accomplishes. Imagine sending thousands of dollars to the bank each month and assuming your ownership stake increased by the same amount. That assumption is the blind spot. The payment clears and your housing remains secure, but the real question is what happened behind the scenes. Homeownership feels productive, which encourages people to stop reading the receipt. Financial discipline begins when you stop asking whether the payment was made and start asking what the payment actually did. A mortgage payment is not one thing. It is a split transaction. The first component is principal, the only portion that reduces your debt and increases equity. The second component is interest, the fee paid to borrow the lender's money. The third component is escrow, which covers taxes and insurance. Depending on the loan, there may also be mortgage insurance or other fees. Each dollar serves a different purpose, even though it arrives as one payment. Principal is the part of the payment that buys back the house from the loan. Interest does something entirely different. It compensates the lender for allowing you to use their capital. Interest does not reduce your balance and does not increase ownership. Yet because principal and interest arrive inside the same payment, many people treat them as equal forms of progress. The reality is that only one of them directly lowers debt. Escrow adds another layer of confusion. Property taxes and homeowners insurance are often collected alongside the mortgage payment. The lender holds these funds and pays the bills later. Escrow may protect the property, but it does not reduce the loan balance. Mortgage insurance and other fees work the same way. These expenses are necessary costs, not ownership gains. Bundling them together makes the true purpose of each dollar harder to see. Because everything is bundled into one payment, your brain treats everything as one category of progress. One amount leaves your checking account, and emotionally, it feels like a housing investment. In reality, part reduces debt, part pays the lender, part covers taxes, and part covers insurance. Without separating those categories, you cannot see where the money actually went. Financial clarity starts when every mortgage payment is divided into equity and non-equity dollars. To understand why early payments behave this way, you must understand amortization. Interest is calculated on the balance you currently owe. At the beginning of a mortgage, the balance is at its highest level. That means interest is also at its highest level. As the balance gradually declines, interest shrinks, and more of each payment can flow toward principal. The process is not random. It follows a predictable mathematical structure. Think of amortization as a seesaw. At the beginning, interest is heavy and principal is light. Over time, as the loan balance falls, the seesaw slowly shifts. Principal becomes heavier while interest becomes lighter. The monthly payment may remain the same, but the internal allocation changes. Understanding this simple visual helps explain why ownership builds slowly in the early years and accelerates later in the life of the loan. Consider a hypothetical 30-year mortgage of $400,000 at 6.5% interest. The principal and interest payment is roughly $2,528 per month. During the first month, approximately $2,166 goes to interest. Only about $362 reduces the balance. The debt declines by a fraction of the amount you actually paid. That is the reality many buyers never expect. The mortgage is not broken, it is designed this way. Interest is calculated on the full outstanding balance, which is largest at the beginning. The bank applies the agreed upon rate according to the contract. The problem is not the math. The problem is that many buyers emotionally expect fast equity growth. When the first statement arrives, they discover that most of the payment covered financing costs rather than ownership gains. The first payment shock often arrives after the excitement of moving into the home. You survived inspections, negotiations, paperwork, and closing. Then the first statement appears. The payment clears, but when you inspect the remaining balance, you notice something surprising. Thousands of dollars left your account, yet the loan balance moved only slightly. The payment stops being a symbol of ownership and becomes a receipt showing how the debt actually behaves. When expectations do not match reality, frustration follows. Buyers who assume every payment builds substantial equity may feel disappointed when they see the numbers. They may believe the bank is taking everything or wonder whether they made a mistake. Yet for informed buyers, the same statement creates no shock at all. They already understand the schedule. The difference is not the payment itself. The difference is preparation. The equity illusion is the belief that every mortgage payment creates ownership in a simple and equal way. Many people assume that living in a home for several years automatically means they own a significant portion through monthly payments alone. In reality, early equity often comes from sources other than the regular payment. Ownership growth is slower and more complex than most buyers imagine. Real equity typically comes from four sources. The first is your down payment, which creates ownership immediately. The second is market appreciation if property values rise. The third is extra principal payments that directly reduce debt. The fourth is time, which gradually shifts the amortization schedule in your favor. Understanding these sources prevents you from overstating your progress and assuming every housing dollar is building wealth equally. Most buyers ask only one question before purchasing a home. Can I afford the monthly payment? They compare income, debts, and projected housing costs. If the payment fits, they move forward. An auditor asks a different question. What is the payment doing? Affordability matters, but function matters more. Understanding where the money goes reveals whether expectations align with reality. Before committing to a mortgage, ask three questions. How much principal will be reduced during the first year? How much interest will be paid to the lender during that same period? How much will go toward taxes, insurance, and other non-equity expenses? These questions transform a housing purchase from an emotional lifestyle decision into a financial audit. The answers reveal what the payment actually accomplishes. People treat mortgages differently from other debts because mortgages feel noble. A car payment feels like debt. A credit card bill feels like debt. Rent feels like an expense. Homeownership is praised by society as a financial achievement, so buyers assume the entire payment is productive. The safer a payment feels, the less scrutiny it receives. That emotional halo often prevents people from auditing the true cost. The amortization schedule is the blueprint of the loan. It shows how much interest you will pay, how much principal you will reduce, and what balance will remain over time. Many buyers ignore it because it looks like a boring spreadsheet. Yet it is the single document that explains the future behavior of the mortgage. Without it, buyers are navigating a 30-year obligation without a map. Using the earlier mortgage example, after 5 years of making every payment, the balance falls from $400,000 to roughly $367,000. More than $150,000 may have been sent to the lender, yet only about $32,000 reduced the debt. The rest paid for the cost of borrowing. Seeing these numbers ahead of time removes emotional surprises later. When buyers first see how much interest they pay, many immediately want to attack the balance with extra principal payments. That reaction feels logical but can create another trap. Before sending additional money to the mortgage, you must review emergency savings, interest rates, other debts, cash flow stability, prepayment rules, opportunity costs, and job security. Reducing debt should never come at the expense of financial resilience. The solution is a yearly mortgage control audit. Track the payment amount, principal portion, interest portion, escrow allocation, remaining balance, annual debt reduction, potential impact of extra payments, and overall budget functionality. If you cannot explain where each part of the payment goes, you do not fully understand the mortgage. Clarity replaces emotional confidence with measurable control. Smart buyers understand 5 realities. The full payment is not equity. Escrow is not ownership. Comfortable payments can hide slow balance reduction. Homeownership costs extend beyond the mortgage itself. And statements matter more than feelings. They do not rely on the emotional satisfaction of owning a home. They rely on accurate tracking of what each dollar actually accomplishes. A mortgage can provide long-term stability while still disappointing buyers who expect rapid equity growth. The goal is not to fear the mortgage, but to understand it. Progress is measured by the statement, not by the feeling of ownership. Review a mortgage schedule, study the principal to interest split, and ask one question: how much of this payment is actually buying back control?